Welcome to the Deferred Comp Advisory Committee meeting. Today is Thursday, March 23rd, 2023. The East Bay Regional Park District intends to hold these committee meetings through a hybrid platform of in-person and remote attendance to allow all members of the public to participate via remote attendance through the Park District's virtual platform. Committee members, with limited exceptions, participate in person at the Park District headquarters, 2950 for Alta Oaks Court, Oakland, California. Occasionally, the committee members may attend remotely pursuant to the Brown Act as amended by AB 2449. Members of the public can view the meeting in the following ways. Today's meeting is held pursuant to the Brown Act. We are providing live audio and video streaming. Members of the public wishing to make a comment can do so by 1, via Zoom, 2, submitting an email to c.swisher@ebparks.org or leaving a voicemail at 510-544-2100. This information is located on the agenda located on the Park District website at www.ebparks.org. And if there are no other questions about the meeting procedures, we will begin. Now we'll begin with a roll call. This is Connie Swisher, recording secretary taking roll call. Chair Meadow Darcy, present. Deborah Spalding, present. Monica Alden, present. Ben Guzman, here. And Pete Boland, here. Okay, great. Thank you, Connie. Okay, so the first item on the agenda is the approval of the January 26th meeting minutes. Does everybody have a chance to review them? Are there any amendments or changes? None, then so I need to make a motion, right?
So moved.
Okay, great. So Pete makes a motion. Is there a second? Seconds. Any discussion? None. Any discussion? All those in favor say aye. All those opposed? And any abstentions? Okay. Motion passes. All right, great. The next item is the Mesero police report for quarter 4. That's not you, Ben. All right, so is Mesero here? Yes. Oh, Mesero, not the chair. Okay, Charles is here. Okay.
Hello, I will give that. Let me just share my screen. There we go.
Thank you, Chaz.
Okay, can everyone hear me okay, I hope?
It's like a little bit indistinct. I don't know if it's on our side or yours, but
I'm sorry, one more time.
I said it's a little bit hard to hear.
Oh, okay. Is that any better? Let me just make sure that let me check something very quickly. Yeah.
I can hear you. Can everybody hear me fine?
Yes. Yeah, you sound
much
great.
easier to hear you.
Yeah.
Can we turn our volume up?
Oh, hold on.
We're working on the volume on our side here.
I got it. I think, is that better?
It says mute on the microphone. Not really.
Slightly better.
Is that better?
So,
No.
See it now? Yeah, so the little arrow next to the microphone.
that guy's
The
like,
other one on the left corner.
what is it?
Yes, there you go. That little tiny there.
And then Shannon also said it sounded clear to her.
Okay.
She thinks it might be the conference room.
Figured it out.
Okay.
Okay.
All right. Well, good to be with you all again. So as we go into the investment review, the first thing that I want to talk about is we're going to talk about how your assets are allocated. That is not part of the Mesero service. I know Hillis will talk about this in a little while, but altogether, I'm going to focus on the bottom half of the page, which is your 138.5 million combined in these 3 different types of plans. These balances are as of March 14. And as I look at this allocation, there is a good use of the breadth of our offering. So I know you have the Mesero oversight on the investments, which is good, and every fund in the lineup is meeting requirements. And I'll show you the Mesero report here in just a second. But you have about 21% in stable value. That has been ticking up lately, mostly because my guess, I don't know for certain, but my guess is that's because with the volatility of the marketplace, people are becoming a little bit more risk averse and moving into lower risk products. However, there are still about $1 in $5 invested in the asset allocation funds, which is good. Study after study shows that it's best to stay the course, as even with the market volatility, staying invested according to your strategy, consistent with your personal risk tolerance, is usually the best, will work out the best in the long run. But you see that almost 60% in single strategy funds. That is the one where it's where I see that there's quite a bit invested in the single strategy funds, which means people are creating their own asset allocation, and I tip my cap to that. That's taking full advantage of our lineup.
Hey Chaz, can you go back for a second?
Sure.
I was just trying to like match up the stuff on the right to the pie chart on the left.
Yeah.
What's the 58%? Which one are those?
That is down the gray and the yellow.
Just gray and yellow.
Yes.
Gray and yellow.
Okay. The asset allocation is the blue and orange,
Yeah.
and the guaranteed income is the light blue, the MSQ RIA.
Oh, cool. Okay, thank you.
Okay.
Yep.
So what did Mesero have to say? Well, first off, in the Mesero materials, the commentary is that, you know, equities had a very bumpy ride in 2022. The fourth quarter had a little bit of a bounce back, but as you can see by the second column here, the year to date, virtually all equity assets, they took it on the chin. They were down double digits. Small caps were down the worst for the year. Now, the only main asset class of this list to have a positive return was cash, and that's good. But it's one of those things that it's the lowest risk, lowest reward, and you can see that it was really a very bumpy year. 2022 was one for the history books, as it turns out. It was the first time in about 100 years that both stocks and bonds, the Bloomberg US aggregate, were down double digits at the same time in the same year. So it was a very rough ride for investors. When we look a little closer at US equities, and again, we'll focus on the year to date with a little bit of a nod to the fourth quarter. It's interesting because the value showed a strong improvement over growth compared to how it normally was working out, that value return. Now, I'm not suggesting down 7.5% is a good thing, but it is far better than down 30%, which is the Russell the large cap growth category. And that value over growth held true throughout mid caps and small caps as well. Looking at the sectors, you can really see that for the year, the dark blue line, we had energy as and utilities, which were the sole sectors that rose on the year. Now, that should not really surprise anyone. We all have seen the inflation of everything, and energy and utilities tend to be things that people need anyway. So you're going to see, if prices rise strongly, that's where you're going to see it. You might see it a little bit in consumer staples. And while consumer staples did not rise for the year, they didn't lose much either. Consumer staples are things like toilet paper and baby formula, diapers. You know, those are the things that you need no matter what the economy and prices are doing. You can see there were three sectors that really dropped far. The communication services down 40%. Consumer discretionary, those are your big ticket items, cars, washers and dryers, that sort of thing. That was down 37%. And then over here, IT was down 28%. And of course, that makes up most of the growth sectors as well. We look at international equities, really, this is a tale of the US dollar. All of the areas in the fourth quarter were up, but for the year were down strongly. Well, if you look at what was happening with the US dollar, it was dropping for the quarter, but for the year, the US dollar was up. Now, a strong US dollar hurts the returns of international equities because of the exchange rate changes. And that's really why the dollar makes a difference. And that's why you see all of these moving in the same direction. That was really the biggest describer. Now, the emerging markets are going to be closely tied to China, this far right. China is over 30% of the emerging markets index. So as goes China, so goes the emerging markets index. And that's why it was down 20% for the year. Interest rates and fixed income, we'll give a quick nod to bonds. You can see over the course of the year how much rates rose. We all felt it. We've seen it in housing prices, et cetera. But the interesting thing is there was not a big move in interest rates sort of from the middle to the outer and to the right-hand side when you look at from the third quarter to the fourth quarter. There is a substantial rise here because that is really what's controlled on the far left by the Federal Reserve. So as they were saying, we're going to raise rates, we're going to raise rates, we're going to raise rates, this is what happens to short-term rates. Long-term rates are moved by market activity. The Federal Reserve does not have a lot to do with that. So this is the dark blue here is what the fourth quarter. If I look at the sectors of the U.S. fixed income market and we look across, it was, again, nowhere really to hide. Asset backs did the best over the year, but they were still down 4%. When you look at the government bonds, they were down, they and credit were down the most. You can see 12 and 15% respectively. So corporate credit, government credit, really nowhere to hide. This is just a table of the indexes that we've reviewed up till now. But here is really why diversification is the most important. If you look at the last 10 years and you try to pick which was the best performing asset class, and you want to put all your chips on black, so to speak, you're going to have a tougher time. Why? Because you take a look and it's very hard to predict. There's a lot of volatility. The asset class that does the best one year is often doing the worst the next. And if you follow the best performer, only once would you really have found been right on the best performer. And that's if you looked at 2019 and then invested in 2020. And as you can, if you'll recall, 2020 ended up a great year, but you would have had to go through kind of a tough first quarter of 2020, where it was down 30% before bouncing back. So we'll have some descriptions, reminder of the methodology from Mesereau. They look at three aspects of quantitative measures: performance, expense, and style consistency. And they look at two aspects of qualitative measures, where they look at the organization overall and the investment policy that they use, and they compare to all of these things. And you would see if there were any issues. As we go through, first, the target date funds are all passing. They were passing the third quarter. They're passing the fourth quarter. There's no source of concern there from Mesereau's perspective. If we look at the U.S. equity funds that are in your lineup, again, everything is passing, was passing last quarter. And as we look at other funds, including your fixed income funds and your non-U.S. equities and your real estate fund, again, everything is passing, both third quarter and fourth quarter. So there's no aspect of the lineup in terms of the investments that are off that have any major problem according to Mesereau. Now there are some considerations that I noticed as I looked at it. One is that there's still 1.4 million in cash management, and while money market rates are tend to rise faster than stable value rates, they also tend to fall faster than stable value rates. And so we might, some of my clients have asked us to do an analysis of cash management versus their stable value fund and see what that might look like in terms of a benefit for participants. I highlight a couple of other things here. There are a number of target risk funds, sort of 60-40, 80-20, 40-60, and then there is and you also have target date funds. Now, there may be some confusion among participants. Most of our plan sponsors are asking us to take a look at what would be the impact of moving into target date funds from an asset allocation. And then there's a lot of overlap. If we were to look at the Morningstar boxes or even the Mesereau style boxes, you would see that there's a lot of overlap in the lineup. And so what some of our clients are asking of us is to do a impact analysis on streamlining their lineup. We're moving from, instead of 45 funds, we skinny it down to maybe 30, but we show how many participants and what assets would be impacted, as well as the impact on cost. So some clients are asking us to do that. If you would like me to, you can say it here, or you can send Hillis a note and he will ask me to go through the same analysis.
Yes, what is the thought process? Because I've heard, so just for everybody who's not maybe followed this as closely, like we are using the Mission Square lineup of funds.
Right.
So you are giving us like 5 large core funds, 3 large growth funds. So that's,
yeah.
What's the thought process for giving us so many options?
Well, there are two things. First off, the standard lineup, and it has to do with evolution, like how it has evolved over time. That's the simple answer. But for example, we started out with our the Mission Square funds, which are a combination of institutional money managers combined in a way to smooth the ride, lower risk, and take reasonable, basically maximize return for reasonable levels of risk. And then there became competitive pressures. People said, you know what, we want this brand name fund. And so we created the Trust Series, the MSQ funds. And MSQ they said, oh, we'll put that into the standard lineup. And then there were, we need index funds. So we'll add those into the standard lineup. So we have 2 in large core, for example, where there are 5. There are 2 index funds, one for just large cap, one for small, mid, and large cap. Then there is a MSQ fund and a Mission Square growth and income fund. There is another MSQ fund. So there, you can see there are, it has been an evolutionary process. Now, one of the things that we should be advertising more, it is disclosed, but it is not advertised, is that although you have our standard lineup, you don't have every fund standard lineup. So we put this all out there as the standard lineup for the purpose of presenting choice to our sponsors. And our sponsors have typically said, all right, we'll take it, rather than saying, well, we want this one, this one, this one, and this one. Keep in mind, I know when I was introduced to you, I've been with Mission Square less than 5 years, and I was the first person hired to be in this role of talking plan sponsors through the idea of how to streamline a lineup, how to construct a lineup, et cetera. And so that is, this is sort of on me for the last couple of years for not bringing this to your attention sooner. But Mission Square as an organization had put the standard lineup forward without emphasizing the fact that you don't need every fund from the standard lineup, if that makes sense to you.
Yeah, thank you. And again, just for folks, I remember when I went to the NAGDA conference, there was a lot of discussion about having too many funds is actually confusing for people who are, sitting there like, "Gee, that's good." I have no idea. And there's, 4 of each type, and you're 5 of each type, and you're like, "Oh, I don't know, I'll just pick this one."
Yeah, it's the term paralysis through analysis. And there's a well-known study, and I'm not going to go into a lot of detail about it, but basically it's called the JAM study. And they set up a table in the supermarket with 3 jams. Call it a blackberry, a grape, and a strawberry. And they had people tasting and then buying the one they liked, etc. And then they set one up with like 15 different types of jams. And I might be exaggerating the number, but the point is there was a jalapeno cherry, and there were a lot of these great esoteric flavors. And what happened was they had this huge line of people interested in tasting all these different things. But when it came time to buy, fewer people bought jams because they couldn't make a decision. It was too much selection. And so we typically, most people would recommend that you make sure you offer enough choice, but not too much. And that's what the analysis will indicate.
Well, and they can still, participants can still self-manage their own funds, right? So, I mean, if they're looking at this lineup and say, I want more diversity, then they can go through that door. Yeah.
Yep.
I'm not sure if they're on the West Coast. Maybe they are, but have you ever heard of Cheesecake Factory?
Mm-hmm. Yeah.
Yeah. Have you ever taken a look at their menu?
Yes.
It's like the most overwhelming thing ever, right? It's like it's hard to make a decision. So I usually reference that example too.
Now,
and they also have managed accounts, so if people want someone to actually review their accounts monthly, quarterly.
Right. The information is there.
Well, and what we'll do is we'll look at the number of participants impacted for any fund we decide to streamline. So you'll have that information. Kelly, you have a question?
Oh yeah, that's a public comment. Maybe we'll take that at the end if that's all right.
Yeah, no, that's fine. This is the last thing I'm going to comment on, and that is I have put in the back, in the appendix, is a full performance lineup. So not just the Mesero review, but also where things are performing. And just to show you, every fund in here is showing up. Every fund in your lineup is showing up here, along with the index and the peer group. And it shows how each one is performing, shows how the index is performing and how the peer group is performing. Then on the far right is the expense ratio. Again, you can compare that to peers. Okay.
Yeah, so we actually received this too late to get it into the packet, so it's not in our packet today, but we can email it out after to everybody.
Perfect. Okay.
Thank you, Chad.
Yeah, I was going to say, I always wondered this too, because I know we do public comment at the end, but then people don't get to comment on the item. So I guess, does that make sense?
Yeah, we can't take it.
Okay, so yeah, I would say let's go ahead and take public comment.
Go ahead, Kelly.
Okay, yeah. First off, I couldn't even find the word Mesero on the website when I did a diligent search using the official website search function. So there's a problem there. I don't know what the problem is, but there's a problem if the word Mesero can't be found on your website search function. So going down my list of notes, the energy sector of the stock market, it's doing great. Well, if you look back over many years, it did lousy. And so now it's kind of, this is its turn, and it's not an accident. Of course, if you look, if any of you still use gasoline cars and don't have electric cars, you might notice, or maybe if you pay your natural gas bill, you might notice the price of energy. Those yield curves that he showed, the number one thing to look there is that that last little blip that we were downplaying here, that's called the inverted yield curve. And the inverted yield curve is famous among the Federal Reserve because it often precedes recessions. And they do that. It's not a coincidence. They probably do that to cause the recession. And that will also impact housing prices and income for this regional park district. And then a lot of this stuff about bonds and pension choices. These long-term bonds, their investors have gotten hit by something that you call unrealized losses, and that's why Silicon Valley Bank is bankrupt, because they had unrealized losses. They thought they could hide them, just like you think you can hide them, whatever, because it doesn't affect you. It only affects your investors, and it's really not the park district. It's the individual investors who are getting hit. But if all of them, if you were running a fund and all your investors show up and want to pull their money out, then that's the Silicon Valley Bank. And there's a book which I think everybody should go out and think about here. I just looked it up. I remember the book. It's called The Paradox of Choice by American psychologist Barry Schwartz. And he argues that eliminating consumer choices can greatly reduce anxiety for shoppers and probably also for pension fund investors. He says that the dramatic explosion in choice, which is what we're seeing here, is paradoxically a problem and not a solution. And he says our obsession with choice encourages us to seek things that are going to make us feel worse instead of better. And this over choice, proliferation of crud, old crud, historical crud, is just confusing people, and there's no reason to hang on to all this. Look, go to Costco. If you guys walk around there, they don't give you, they decided to only give you a few choices because it's more profitable for them. And the Costco shoppers aren't really getting hurt by having fewer brands of toilet paper to buy. Thanks.
Thank you.
Okay. Any other public comment on that item or anything else to add?
You can see that email.
So I wanted to, Chaz had suggested that we could have him take a look at where all of our participants are invested. So for the 5 growth funds, take a look at where people are invested, and then also take a look at the last pages of and I guess we'll have the next quarter report pretty soon. And take a look at what are the best funds of the 5 we've got out there, and think about do we want to pare these back. So I would like to propose that we take Chaz up on that offer, and we don't need to jump and make the change all right away, but just take a look and see how it's looking, and maybe think about hearing that the option.
As an aside, there is no additional cost, by the way.
Yeah, what is that gonna cost us?
Well, it's worth considering, but we have to explain it very carefully to the participants, because the first thing, they're narrowing the choices. There's going to be a lot of people, and there's sort of what with the employer contribution, there's a real atmosphere of distrust about the plan. So we've got to be very careful about how we explain that. But it's
just take a look at where
it's certainly worth
data lies, and
considering.
then we can decide what we want to do, if anything.
And even if we scale back, if you're in a fund, you're not going to give them not participate in that fund, right? So
We would move people to feel okay, that fund's, if we were to do that, and again, we'd have to look at that, and maybe there'll be some funds nobody's in.
ever been in.
We'll just cross it off the list.
Right.
Or maybe one person's in it, and we just reach out to them, okay with us. It's, performing less well than the other ones. We're trying to help people out. And so we'll just have to look at the data, and maybe we do want to do some, maybe we don't.
Yeah, certainly worth considering.
Okay. Cool. Thank you for suggesting that.
Okay, so next on our agenda, we have Secure Act 2.0. Is that you, Phyllis, or is that you, Charles?
That is me.
All right.
So I will share my screen, and then just let me know when you see it. And you can hear me still fine. It's not too loud, because I know you could hear me good before, but it's not too loud now, is it?
No, it's great.
Okay, perfect. And just let me know when you can see the current industry focus screen. Okay, thank you. So I just wanted to give a little bit of context here. So this is just an overall industry focus when it comes to just the retirement world. So you have financial wellness and digital experience, cybersecurity, advice, including digital advice, which is really sort of the basis of the platform transition. But then you also have some things that are byproducts of Secure Act 2.0. The emergency savings and the student loan programs. Student loan programs were interesting for a while too, because there was that potential forgiveness there, $10,000 or $20,000, depending on if you qualified or had a Pell Grant. But there's also some things, some provisions woven into Secure Act 2.0 that's also meant to help with student loan programs and could be an interesting sort of recruitment tool, if you will. So just wanted to provide a little bit of context on the focus and then how it plays into what I'm about to go over now, which is Secure Act 2.0. The first provision you see, pretty self-explanatory. So the RMD age is now 73. It turns.
Sorry to interrupt. We used to use it like, don't use the acronym, but say the whole word for those of us who aren't as familiar.
Oh, okay. I'm sorry. So the required minimum distribution.
Do you know what that is?
Yeah.
Everybody's familiar?
Yeah.
Okay. All right. So it changed. It was 72 in 2022, and now it's going to be 73 starting this year. There are going to be notices, if not already, sent out to people who this actually affects through their statements, as well as online. Anybody who was taking an RMD before basically is still status quo. They're unaffected. They're still going to go off the same table and calculation moving forward, and they're going to still be required to take a required minimum distribution. And this age is going to increase to 75 in 2033. Usually they do it in step ups. I'm not exactly sure, when the next step up is going to be. Usually it's like in, half age ranges. So you'll see like the RMD age at some point be like 72 and a half, like it was. So we anticipated it to step up, but it has a great deal of time to step up since it's not going to go to 75 until 2033. The second one, I think we spent some time on this, Deborah and Monica, and that's the catch-up contributions, specifically the age-based catch-up contributions. So starting in 2024, if you make $145,000 or more the previous year with your current employer of whatever plan you're in, then your age-based catch-up contribution, so your age 50, the additional $7,500 has to be on a Roth basis. It can no longer be pre-tax if you are above that income requirement. And you see the word index there. Index just means that there is a COLA, or a cost of living adjustment associated with it. So over time, it's going to increase with things like, inflation. It's just over time, things get a little bit more expensive. So that limit's going to go up as things do. The thing about the the catch-up contribution is this isn't going to affect your pre-retirement catch up. So the one where you're 3 years within that retirement age and you haven't been maxing out your benefit, and you can potentially contribute up to 45,000 or double, the normal limit. That's still going to be available for pre-tax, and we make that distinction on the website and with you all, so you know whether somebody is utilizing that pre-retirement catch up, or the age-based. But that age-based is going to have to be Roth if you make $145,000 or more. So any questions on that? Because I know that's sort of a lot, and this is the one we usually spend a lot of time on.
How do we message this? I mean, like, who messages this, I guess is the question. Is this something Mission Square messages to our participants? Is it something we're expected to message to our participants?
Well,
So
the thing
depend-
is, sorry, Helens,
Yep.
it's not automatic, so if you turn 50, you're not automatically enrolled in this program, you have to elect it. So in order to elect it, I think, it'd be great if Mission Square can provide some information in advance, but once the employee elects to participate in the program, there's gonna have to be a coordination between HR and finance to determine what their income was the prior year. If they came to us in the middle of the year from another employer, obviously, even if they do potentially exceed the 145, it's just gonna be based on their salary here. So it is gonna be a collaboration between HR and finance to be able to determine whether this person's gonna be doing it after tax or pre-tax. And at that point, we'll tell them. So it's not applicable to everyone.
I mean, I'm just thinking somebody might have plans to do catch-ups at certain, I'm gonna get a promotion next year, I'm gonna get a step increase next year, I'll do it then, and so being able to plan and say, oh, it's gonna be different then, so maybe I should do it now. Yeah, I'm just
So-
wondering how we can message that out.
So we could do education around it. As we go through Secure Act 2.0, you'll see which provisions in here are actually optional and what you want to implement into the plan. I think it makes sense to, once we figure out which provisions we do want to implement, maybe just doing a presentation as a whole, including the whole Roth aspect of it, so participants know what's happening, all at the same time, rather than just trying to figure out and piece together. We can do a presentation and then send out that presentation following, so they can just have all that information available to reference to.
Yeah, and I think my concern about, we can try to educate our participants, but obviously there's only so many people we can reach to, but I think my concern is sometimes like if Mission Square, sends out an email and says Secure Act 2.0, people are like, I don't know, it's doesn't seem important, sorry, Mission Square, but it just doesn't seem like just like a regular, email of stuff that, we don't pay attention to. But I'm also thinking like coming from the district saying, hey, there's some significant changes with Secure Act 2.0. Here's a list of them. If you want to know more, there's a workshop or something, just so that and then maybe we could forward to the retirees. I don't know, just to have it coming from different places, because, not everybody may be in contact with the representative on this committee. Not everybody reads their Mission Square emails, just being able to catch it from different areas.
Well, we do have the monthly newsletter again that we're doing, so we can definitely include it there, and any new additions that will improve or recommend for the 2.0. So we can definitely do it there. We continue to use our benefit SharePoint site, and on that site is the link to Mission Square so that they can also see it. So I have a question, Phyllis. So let's say someone does sign up and initially, since it goes based on the prior year, they're below the 145. Next year it goes up again because it's tied to the COLA. If they remain under that index amount, they're still able to do pre-tax. It's not like you apply and reapply every year for the catch-up plan. So once you're in, you're in. So that's the other concern.
I thought the catch-up was designated every year.
No.
So the age base is pretty much discretionary. It's all dependent upon what the participants contribute in. They don't have to once they start utilizing the age-based catch-up, they don't have to commit to it each year.
Well, doesn't it say in the bottom here, special catch-up contribution rules for 457B plans exempt?
So special catch-up contribution, that's the same thing as the pre-retirement catch-up. So that's separate from the age-based. That's the one when you're within, 3 years of the retirement age designated in the plan. And you can do this year, for example, it's $45,000 up to $45,000 if you haven't been maxing out, your contributions in the prior years. Kim walks people through a table to come up with that calculation, and it's a form and there's a table and stuff, and we calculate what the pre-retirement catch-up limit is going to be for that individual, but it's separate from just the standard additional 7,500 or whatever else is going to be going forward.
It looks to me like it's quite possible that there aren't any district employees at all, or very few, if any, that fall into these categories. I mean, I guess I'm asking that as a question. And if there aren't, then we can just, when people apply for it, we can explain to them rather than bombard them with information that really, from their point of view, is useless.
Yeah, and again, this 145 is their base salary, net or gross?
So it includes everything. So even if people are doing overtime or bonuses, it's the total wages coming from the district.
That could vary.
Yeah, that's tricky.
Do we know if there is anybody using the age-based catch-up
I
provision
have,
in the
we
district?
have at least 20.
Oh, okay, well, that's a different matter. Okay,
Yeah.
so I withdraw that.
So maybe if I could get a better explanation to the difference between pre-retirement catch-up and age-based catch-up.
Did you hear that, Alex?
I did not, I'm sorry.
Can you maybe explain the difference between an age-based catch-up contributions and pre-retirement contributions? Like, what's the distinguishing factor between those two?
So the age-based catch-up, if you're age 50 or above, and they have an option in here too for an additional, age base for those that are between the ages of 60 and 63. I'll get to that, and that just adds a little bit more confusion to things. But basically, if you, just to keep it simple right now, we just use the age 51. If you're age 50 and above, you can do the 22,500 to max out your deferred contribution, but you also can do an additional 7,500, and that's the age-based catch-up that they're referencing right here. So you can do a total of 30,000 in terms of contributing into your deferred comp plan.
So, but if I'm under 50, I'm only
Under 50,
you're only eligible
only-
for the pre-retirement catch-up.
yep.
So-
Well, so you're just no. So it depends. It depends on, well, most likely no. If you're under age 50, usually the retirement age for plans are kind of like 59 and a half or somewhere in that range. So you would probably still not be eligible for the pre-retirement under the age of 50. So, you could only, under the age of 50, you can only do 22,500. Once you hit 50.
That's the pre-retirement.
No, that's just your deferred comp limit.
Okay, got it.
Yeah, the pre-retirement catch-up is just like a whole nother
Just contribution limit. That's just a contribution.
limit
Okay,
and
okay.
yeah, catch-up
So-
provision.
So there's a 22,500 contribution limit normally.
Yes.
And then, so what's this so that's another category. So then there's 3 categories then? Then there's age-based and there's pre-retirement? What's the difference between those two?
Yeah, so age base is just in reference to your age if you qualify based off your age. So if you're 50 or above, you can do an additional 7,500.
Okay.
And I can look at your retirement age for the 457, so I can give you an example. Yeah, 59 and a half. So if you're 59 and a half and you were within 3 years of 59 and a half, you can qualify for a pre-retirement catch-up contribution. And this is when that calculation and the table and the form comes into play. And that limit, that can actually allow you to contribute up to 45,000 or double the normal contribution limit if you are within that specific time frame.
What
It's
is meant to
really-
be
and a half, if I'm 59 and a half.
3
if
years?
you're within, yeah, if you're within 3
6
years,
and a
so you
half,
can do it.
okay.
So you can do it for 3 years.
Okay, so 3
And then
years.
once you hit that, once you contribute in that window, you're done. You can't use that catch up again. You can use this. You can still use the age-based catch ups, but you can't do the pre-retirement anymore.
Okay,
And it's really intended to catch up whatever you never maximized in the past.
Right. If you notice, so yeah, it's meant to like make up for all those
for all the
years.
interest
that you-
contributions that you missed out on because you didn't. It's kind of like buying,
Yeah,
it's kind of like buying time back from PERS, where it's not the actual time you would have, you also have to pay for almost the interest that you would have earned so that you can contribute into the plan.
Not
So it's
really, so let's say the max contribution 10 years ago was 15,
Mhm.
but you only contributed 10.
Oh, I
That
see.
5,000
you're-
you didn't contribute, you
You
can
can-
contribute now
I see.
within that pre-retirement.
But that catch-up can't exceed the amount that Monica just
That
mentioned.
5,000.
You have to account for every dollar by having contributed less than the maximum prior years with the district.
Got it. Okay, that makes sense then. Okay,
yeah. So they were basically saying if somebody was trying to do that as a Roth contribution, that could really make a huge impact. So they kept that one out. So it's only the age 50. But any other questions? There are some other things that I think we're already at the 10-minute limit. So I just want to make sure we kind of hit
I just had a
some of
question.
the others at a high level.
It says that it requires immediate attention. When do we have to We have to take action to adopt this, is that right? Or,
I think it's just a law change, no?
it is a law change, but it says like requiring immediate attention. Is it that we have to take action on that?
So this is, we're still kind of working out the plan documents and so forth and how to implement it. So this is going to be starting in 2024. I think the immediate action is you kind of got to start thinking about it because from an administrative standpoint, there's some things that you have to do behind the scenes, and some people they don't even have Roth available in their 457. So you got to start thinking about amending the plan document to allow for Roth contributions. Some people, well, actually, it's not some people. Nobody's doing this, but you could even say, well, we don't even want to allow catch-up contributions in our plan. That would have to, require some adjustments to the documents as well. So that's why it sort of requires immediate attention, because it says 2024, but in the grand scheme of things, that will come up pretty quickly.
So we have to do changes to our plan document in order to implement whichever one of these we decide to implement, correct?
These ones are mandatory,
Right.
so they're
I think-
happening, yeah, while
They're just
updating.
updating.
And
Yeah,
some
if you're using,
saying that like, you're looking to see that the standard plan docs need to be changed, so they don't know yet, but if they do, then we will have to take action and do something.
Update.
yeah, if
Well,
you're using
accept
if you're using our standard plan document, we're pretty much just going to change the language to allow, kind of flexibility to capture this, just like an overarching sort of thing. But specifically where you kind of get into the nuances of what's available for each plan is in the provisions, and we would just have to change the provisions for probably most of these that we go through. It's just like an extension or a extra document, if you will, in addition to the plan document that just specifies the provisions that you want. All right, so the first one, self-certification for unforeseeable emergency withdrawals. This is optional, so you'll start seeing it listed as optional. The star is going to mean that it's technically not required, but we think most plans are going to adopt it. This first one is pretty much a byproduct of the CARES Act, where in 2020, people were allowed to self-certify an emergency withdrawal. So they pretty much just extended this and said this can be an option going forward for plans if they want to do it. Just as a heads up, a lot of people have said no to this, that they prefer some sort of oversight, just so people aren't getting themselves in any sort of tax trouble by saying, their withdrawal qualifies when it really shouldn't, right? And then they get audited and then it becomes a problem for them later. We still think there should be some oversight on that, but it is an option for people to self-certify these going forward. It's effective now. We're not ready to implement it. If you did allow people to self-certify, just as a heads up, there's just some things from a systematic standpoint, as well as a systematic and implementation standpoint, that we're just not ready to roll this out just yet. But I can let you know when we are, if you are interested. Something to think about. I wouldn't say you have to make a decision about it today. Elimination of the first day of the month rule for 457s. It pretty much just made it standard with everything else in the deferred comp world, right? So 401ks, 403bs, and so forth. You can basically make a change to your contribution as soon as administratively possible. And if your payroll can process it, they're saying the same for the 457. So if somebody changes their contribution at the beginning of April, they no longer have to wait until May for it to reflect. It can actually reflect in the next payroll cycle. There's no documentation really needed for this at the moment, since it is law. We'll adjust our plan document to allow flexibility depending on what the plan sponsor chooses. But just know you can implement this as soon as administratively possible, and if your payroll can process these in the time frame that they want. And then the RMDs for designated Roth accounts. So currently, because it's not 2024 yet, you have to take an RMD for your even in the Roth bucket of your 457. For Roth IRA, you do not have to take an RMD, and it's tax-free, of course. So they're aligning the rules of your deferred comp Roth with the Roth IRAs. I think this just makes a lot of sense. It is optional, but we expect most plans to adopt it, and we recommend adopting it because it'll actually allow for more plan retention. A lot of people who, if they do have Roth accounts and they retire, they do roll it out into an IRA because they don't want to take RMDs on it. That was one of the main purposes of using it in the first place in their mind. So any questions about these three?
So again, you'll let us know, like, if we need to take action to amend our plan.
We'll decide what to do with those.
Yeah, are we deciding that now, or are we deciding?
Maybe we'll like run through them all and then we can.
Sure.
I'm sorry, were we about to decide on something?
Are we deciding on this today, or is this something you'll present to us at a later time to make these decisions?
Oh yeah, we can just go over it again. I'll send this out so you can see the provisions, think about them, and then we can revisit and actually maybe schedule a time to do votes or however we want to kind of.
It's not super urgent.
Yeah.
Okay, great. Yeah, and people did get this in the packet, so everyone has it already.
Deborah?
Hey, I think, yep.
Hi, everybody. I just wanted to say that this is kind of dense information. So from the district side, we will decide if there are any actions that need to be taken. We'll let the committee know what our recommendation is, and then the board would have to make those, take those actions. So it would have to go to the board if there was any kind of plan amendment or, you know, decision on at that level, at the fiduciary level.
So are you saying that because I think that's our role, is to make recommendations, right? And so are you saying that then the district's gonna decide and make, or like, I'm confused.
It would, I think I'm saying the same thing you are, that we need a follow-up conversation so that we can talk through these options. On the district side, we will absolutely be analyzing these as well. And so maybe at our next meeting, we could have a follow-up item.
More information.
Bring that information and discuss what the recommendations would be from both the committee and from the district before it goes forward to the board. It, you know, we're only in March right now, so we have several months to get this done. It doesn't have to be at the next meeting.
But it looks like a lot of these are effective 2023, right?
They're available.
They're available, right? So they're optional, right? So it depends on when you want to implement them, even if, or if you want to implement them at all. So you just say we're not electing to use them right now, and that's perfectly fine.
Okay. So Connie, can we put that on the agenda for the next meeting? Great, perfect.
So Hillis, we're not doing anything right now. These are ones that we have the option to do in the future.
The doors.
Correct.
Right?
I mean, other than just the RMD one, because that's pretty much law and it's in place. But everything else you see is pretty much optional. Other than also, I guess the Roth thing, that's not optional either, but that's not until 2024. But everything in 2023 is optional, so we have some time. So higher age-based catch-up contribution limit. This is optional if people fall within the ages of 60 to 63. I don't know why it's only 60 to 63. If you're 64, you can't use it, but you can have a catch-up that is greater of 10,000 or 150% of the regular catch-up, regular age-based catch-up. So, for example, right now it's 7,500, so 150%. You know, that 10,000, and that's going to go on that based off that indexed model or that cost of living adjustment model as well. So that'll go up over time. We have a couple of years until this one. If you want to kind of think about that, you got some time, definitely. The other one is long-term part-time coverage rule. That's for 401k, so that doesn't apply. But I'm sorry, Pete, I didn't mean to cut you off.
Does this, the one you just finished on, the higher catch-up contribution limit, does that affect only the age-based catch-up or the pre-retirement as well?
Only the age-based.
Thanks.
What
So
was
these
that
are both,
second one? Sorry, on the,
oh yeah,
what was the second one on the list?
It only applies to 401s.
it's
Oh.
only 401ks, so I just said, don't even worry about it.
All right, thank you.
We already got enough to retain. Don't need to throw in something that won't affect you. So 2024, these are the emergency savings withdrawal provisions that are available. The first one is more so of like a distribution option. That just requires a little less oversight than emergency withdrawal. The second one is to actually have an emergency savings account bucket within your deferred comp plan. So you would be able to basically have a pre-retirement bucket, a Roth bucket, and then an emergency savings bucket. That 2,500 goes against your contribution limit, and it must be a Roth contribution. The investments in this bucket also have to be capital, preservation investments. So stable value, cash management type strategies, because it's really supposed to operate and function like an emergency savings. It's not meant to kind of put in any sort of risky assets. We want that money to be available for people when they need it. But they don't really have anything holding them back from, actually getting that money. I guess the thought process behind this, though, is that it's in your deferred comp plan. It's not just like in your normal savings, so you're not just withdrawing and transferring that money whenever you want. And then also it's just easy because it can just be deferred through your paycheck. The thing I will finally note on this one is that that $2,500, that's the limit. It can't go any higher than that. So as soon as you hit that $2,500, no more money can go into this bucket, and you'll just have to replenish it up to $2,500 if you take money out. But that's just sort of the constraints on it.
And is this 2,500 a year
Yes,
or
it's a-
2,500 period?
So it's $2,500 period. So it's like in that bucket, if you have $2,500, then
I see.
that's just the amount that can be in it. And
You
I don't see any language
replenish.
saying it could be, yeah.
So it's not necessarily a one-time, it's just that up to 2,500 and you can replenish if you pull it out and you can replenish up to 25. Is that kind of how it would work?
Yep. So if you have $2,500 you saved in there, something comes up with your car, you need $1,000, you take $1,000 out, you're down to 1,500. You can save in it again. Once you hit that $2,500 limit, you're done again. It's
And maybe I'm getting too technical, but so I'm trying to think of how this will work on like the payroll side. So does someone have to say like, all right, I want to set up an emergency savings account, and then they'll have like an additional deduction coming out each pay period to fill up that bucket. And then it's also part of the 22,500 max.
it's administratively it's pretty complicated.
Yeah. Well, and then the emergency savings withdrawal, I was trying to figure out, is that Roth only, or is that
That one's not.
Roth? That one is.
That's like
pre-tax.
within your regular, well,
So is this, I mean, I know it says both available, but is this generally like a either or both? Because, I mean, could someone potentially have $3,500 if they pulled out that year? Let's say we adopted both.
Yeah, I guess you could say both. Yeah, both are available, but I've just experienced people pretty much using either or,
Okay.
just because of the administrative burden, I guess, that comes
Yeah.
with, especially the emergency savings account. That it's either they want to do the emergency savings account or they'll just have the withdrawal provision.
I kind of feel like if you're having an emergency, you're not gonna plan. You know what I mean? Like most people that are like pulling money out of your Roth, like you're in pretty desperate straits, you know, and so you would probably didn't put that ahead of time. So to me, it seems like the $1,000 is easier for the participants to access.
On the emergency savings account, do we know if the last item is must ensure state law allows? Do you have any idea if the California allows that?
That's a good question. I haven't looked at the full list, but I think California was, you know, on it. I'll double check though, but
We
I
should
think,
know that
I think,
before we seriously consider it.
absolutely. I think a lot of it's still being worked out on, you know, if they're going to allow it, not allow it, and how we're going to, you know, truly implement it, especially for the things with a date of 2024. So that's a good question. I'll be sure to get back to you on it. But California is pretty good about, you know, setting things up for retirement for folks. They usually try and implement anything they can, and even I think it was the first state to really require employers, small businesses to have some sort of retirement options. So I think the phase, I think it might be, it might be completed now, but there was just, remember, something was passed where basically if you have a certain number of employees, you were required to have a retirement plan, and depending on the amount of employees you had, that was the time frame that you had to implement it. So I think California, I would say yes, but I'll double check.
On the emergency savings withdrawal, it says that the 10% penalty is waived, but then it says the bill contains an additional 10% penalty. Wait, so I'm confused on, is it charging 10 or is it adding an additional 10? I mean, is it taking, you know, is it waiving the 10 and then charging 10?
10%, yeah.
But then you have a 10% penalty waiver if you have those conditions. So what are we waiving?
10% more.
So you waive the 10%, and I'm not sure if they're just waiving an additional 10% on the tax. So you're waiving the penalty, but this distribution still would be taxed at your income.
So maybe is it 10, because it's usually like what, a 25% tax penalty or I forget, it's pretty. I just wasn't sure, like,
It's usually 10%. You're right.
so like, yeah, I think it's confusing if it's waiving the 10%, why would I need to get a waiver to waive an additional 10%?
So I think I think the way it's reading, so it's structured like the qualified birth or adoption distribution. So one emergency distribution per year up to $1,000 requires replenishment, self-certification. So I think the 10% penalty is maybe that first line item is referencing the qualified birth or adoption distribution specifically. And then it's saying there's an additional 10% penalty waiver for terminal illness and victims of domestic abuse. But actually, never mind, that wouldn't make any sense. I'll have to see what that additional 10% is.
Could it be that the 10% waiving is something that the district decides on, but the 10% waiver for terminal illness and victims of domestic abuse is automatic because it's part of the bill?
That's a good question. I'm not sure. I would have to go to our legal counsel and get their full interpretation on that one. That's a good question. That's the first time I've had it come up.
Okay.
And let's see, there's a couple more. How are we looking on time? Do you all want me to go through just the student loans and the rest of the provisions, or do you think in the sake of time, you want me to just send this out and then we continue discussion? Because I know we have other items. I just want to be respectful.
Yeah, might need to, it's 11:36. Yeah. Over at noon. So yeah, I think we should just have maybe send it out or have people review and we can maybe discuss it more in the next meeting.
Okay.
So maybe Connie, if we could get a good chunk of time in the next one on this. Okay. I don't know.
In May.
Yeah.
All right, and then I think I have the next items as well. It's the peer benchmarking, and I'm just trying to pull up my agenda. Participation rates and peer benchmarking. Okay, How quickly, I guess, do you want me to go through these? Because I know we have other items.
An overview, we can decide what we want to discuss more of.
Okay. So I thought I'll just go over the plan data just to give you context. The peer benchmarking is available in the plan health dashboard. So somebody could probably just pull that up, but then I'll just give the context that's probably needed, for it. And then I'll go over the financial wellness portion, then just to kind of cut time. So let me know when you can see my screen, and then I'll just go over how your plans basically are, how they were looking at the end of 2022, just so you have that foundation. You can see the screen?
We see it, yeah.
Yeah.
Okay, perfect. So this is going to be different than the balances that you saw, with Chaz, because this is based off the end of 2022. We have seen a little bit of, our market, I wouldn't say recovery, but we've seen it treat us a little bit better than it did last year, at least in the meantime. So you see you have your total balance right now across all your plans of 135.5 million, and participant counts of 1,193. The participant accounts, that number is up, the plan balance is down. So at the end of 2021, to put it in perspective, the plan was close to 160 million. So we've seen about a 16% decrease in the amount of assets, and that's mostly due to the market. I think Chaz gave you an overview of just the performance and the benchmarks, and this is pretty much right in line with it. I would say also just the amount of the cash flow situation for the plan. We were cash flow negative for 2022. That means more rollouts or more money going out of the plan versus coming in. So that didn't help that plan balance either. But a lot of the reason for the outflows that I've noticed with you all is due to really just you have a lot of assets in what I would call more vulnerable clients in terms of the potential for rollout, or they are required to take distributions. So if you take a look at the chart on the left, you can see the different age categories. The ones that I want you to focus on is this purple one here, this magenta, I guess you would call it, and the pink. So you can see you have substantial assets in the plan that are with people from the ages of 50 and above. Basically, almost all of the plan assets, about over 85%, are with those people. So they're more subject to either have to take a distribution. They're targeted by financial advisors and are subject to roll out their money. So it's really hard to kind of focus on the contributions and having a positive cash flow when you have so many assets that are subject to outflow. So one of the main things that we'll talk about once we go over the education strategy in the next meeting is how we're going to focus on retention and providing services to pretty much these vulnerable sets of participants.
Hey, Hills, can I make sure I saw it, like you were hovering and I was like catching on kind of late. So the magenta and the purple, like, so 65% of our assets are like probably already retired people, most likely. Oh wait, no, the
Yeah, I
purple
would
one
say
is-
actually probably more so like 60% of people. So this is
okay, so
69
the
and
pink,
above.
magenta.
Yeah,
Okay, so
69 and above is about 26 million and almost 20% of your assets. And then about 41% is people from 60 to 69. I would guess the majority of these folks are retired. So 60% of the assets being with retired folks, you're just kind of subject to having a lot of people.
I know, man.
Yeah.
It's like, I want it done this way. My people got all the money in this thing.
Well, the thing is, I guess everybody just does a good job of saving there. I guess I could point out that in terms of just your overall kind of population, so the makeup of it, just based off the age groups, so the number of folks, it's pretty diverse. So you even see a little bit more. You have 208 people in the plan that are aged 30 to 39, and 249 people who are aged 40 to 49. So most of those people active, they're working, they're accumulating. It's just these age groups right here, even though maybe percentage wise they're pretty equal, they just hold so much assets, and they kind of dictate the flow, if you will, of the cash flow, overall cash flow for the plan.
What's the difference between this chart and the prior chart? That's
So this is the overall participant count. So the number of participants, and then this is
assets.
the number of the amount of assets. So the participant count is pretty diverse, and you have it equally distributed. But when it comes to who actually has the money in the plan, it makes sense though, right? They just had so much time to accumulate and save for retirement, but it's your people who are age 50 and above that have all the money.
Thank you.
So I'm wondering, I think we talked before about getting statistics. Is this something we could have, a report sent out? I don't know if it's too often, but even on a monthly basis, just to kind of see what's changing, so that when we come to the meetings, we can say, wow, in the last 3 months, we've increased this or dropped this or something. Is there a way to get like a sort of a standard report that we can have
Absolutely.
sent out?
Yeah, once we finish the meeting, I can send this out to you.
Okay. Yeah, I mean, I think like on a regular basis, like, I don't know if there's a, we can say like by the 1st of the month or the 15th of the month or something like that. I know Pete's been asking for, to get some of those numbers, and I'm wondering if maybe you and Pete could hook up and talk about maybe what factors we would probably want to see. Like participant count, asset, but also I'm thinking like contribution rates. I'd be curious to see who's contributing, a large chunk, those kind of things. So maybe just look at like some of the basics and data, and then if there's more, when we get the report, if there's more we can add or delete. But I know Pete's been really wanting it. So is there a way to get this on a regular basis sent out?
Yeah, just shoot me a note, or I can just come up with some sort of schedule that we can come to an agreement to on when you actually want to see the numbers on a certain cadence, and just make sure it's ready for you.
Yeah, if there's a date that you think is better, there's a reporting date that you want to follow or something like that on your end, just let us know what you think would be a good date, 1st, 15th, end of the month, however you think it would report best. And then that way we'll be able to have that on a schedule, and we can, have that data, coming in.
Yeah. I'll certainly do that. And then there's just an overall breakdown. So Chaz showed you just like the total amounts that are in each asset class. So this is how you can see how they're distributed based off their, their age bracket. So again, you can see that 60 to 69 category, a lot of the assets there, well, really across these 3 age groups, but you can also see how they're, investing. So a lot of people are pretty much using some sort of US stock market, fund, and then also kind of balancing it out with the stable value. And then the blue bar at the bottom is the target dates or the, balanced asset funds. And those 3 make up the largest in the plan there. Sorry, I'm just moving quickly because I know now we got like 15 minutes. And I wanted to show you this one because I think this one's pretty good. So the top is just the asset allocation, how it's changed over the course of last year, just in terms of like a total distribution perspective. So obviously the balanced asset allocation and the stable value, they didn't have as much of an impact in terms of returns as like a US stock or pretty much just the US stock. But what I usually like to pay attention to for the most part is the one at the bottom. This is the contribution allocation trend. So this is a real measurement of behavior. You can actually see how people are investing their money and how that's changing over the course of the year. So you see a lot of people actually have not been contributing not contributing as much into the US stock bond, and more so the individual asset classes, and they're actually now more relying upon a balanced asset allocation or a target date fund. I think last year, you saw a lot of people reassess risk. They were, probably talking to Kim, or they just realized they a little bit more risk averse than they thought they were when everything was going good. So we started to see more assets flow into that balanced asset allocation. That tends to be a little bit more out of sight, out of mind, and actively managed within those funds. So I think people just saw that peace of mind there. And then there was a 3.43% increase going into the stable value or the cash management strategies from January through the end of December. And I think lastly, I'll just show you this chart. This kind of tells the overall story of how hard it is to actually retain assets and the age demographic. So you see over the course of the last 5 years, really, we've had more outflow than inflow. And I pretty much attribute it all to just having most of your assets with those people who are more likely to do something like roll their money out. I think you see a little bit more of a bump in 2022 because in times of market volatility, that's when you see actually a lot more outflow, because that's when financial advisors, insurance companies, and things like that, that's when they're the most active, right? They're throwing around guaranteed income options, annuities. They're showing you historical returns on a portfolio that would have done well. So people kind of gravitate towards these outside influences, and they're more likely to roll their money out. So I think that's what we saw in 2022 versus the previous years, where it was a little bit more stabilized just because of that volatility we saw. But any questions on, I guess, like the last two things that I went over?
What is it? It looks like there's two different ways you can just there's a little toggle, you do cash flow normal or cash flow all. What is the difference between them?
Yeah, so they're pretty much the same. I haven't seen anything that is included in the all that's not included in the normal. I don't even know why that button's there.
Okay, it says down the bottom.
And Pete, I can also just give you like the contribution distribution like breakdowns too, so I can show you what came in through roll-ins, what came through in the contributions, what was the most thing that caused outflow. So a lot of the rollovers or the rollouts, but there's also people taking lump sum distributions, and then even over 300,000 in required minimum distribution. So just a lot going on with that. That older demographic, I would say, that just causes a lot more outflow. So retention will be a big thing that we focus on with education and the tools that lead to retention. And then the only thing I was going to show you then is just the this is my last thing, is this is sort of leads into just the financial wellness benchmarking. And I know we have 10 minutes, so I'll just give you a high level overview. But what we're really tracking, and one of the first things that we'll implement in terms of education for this year, is financial wellness. Not only to get more data on this, but financial wellness is actually good for retention, because people are meeting with CFPs or utilizing the tools here to get more information on insurance, how to really balance their portfolio during retirement, income strategies, and so forth. But you can see that we're really starting to track just the average points by users, the total points. But what I really want to show you is the results of the questionnaire. So it's starting to encourage people to really take the questionnaire so we can basically see how we really want to help, or how we can help. So what categories are they, excellent, great, good, or need help in? So prepare for anything, save more, invest wisely. These are all stuff that's embedded in the Financial Wellness Center, and they have different sort of
I'm lost.
Yeah,
No,
what
I'm
was
lost.
that?
So
What was that thing?
This is the questionnaire that we sent out?
no, so this is in the Financial Wellness Center. So there's a questionnaire. Once you go in, it's 10 questions, and it just asks you different things
Well,
from
the participants are filling this out.
Yes,
They're
this is the
they're self-directing
participants.
to it, okay.
Yeah, so we want to drive engagement to the Financial Wellness Center so we can get some of these answers. So what are they really interacting with? And then what questions do they have? So these are the questions, the actual questions that they're answering. Have you identified your financial goals? How much do you owe? So trying to see if we need to really focus on any sort of education for debt management or payoff strategies, which categories or which best characterizes your use of credit cards. If you suddenly lost your job and had no income, how much of an emergency savings would you have? So really seeing if people have adequate savings, and then maybe this dictates whether we do have like an emergency savings provision or whether we, just have the withdrawal. The other questions, how would you describe your ability to save? What best describes your retirement saving strategies? So I'll send this out just so you can see the questions. But I just wanted to show you there's not enough sample size, I don't think, to really rely on this just yet. So that's why we do really want to drive a little bit more engagement.
And
Well,
just
we
to
can
confirm,
see.
this was this is self-directed questionnaire. This is the question? It's not the questionnaire we sent out.
Yeah.
So this is, I'm already in my online account, clicking around, and then I filled out these questions. Is that correct? These are
Yep.
already highly active members that are, okay.
And how many people filled out the questionnaire?
So for the questionnaire, let's see. Go back up. So 2, 3, 5, 8 people. Not a lot of people.
Okay, never mind.
Yeah.
So they'd have to log in.
Yeah, I mean, they'd have to have an account, log in, like, and they're proud. So I mean, because I was like, wow, these people are really progressive.
Me
Well, yeah,
too.
they're very progressive.
Yeah.
They're already highly active.
Yeah, no, we need to see more people use it. But I just wanted to show you that we're trying to measure it. We want to try and increase some engagement with it because really we get a lot of good information out of it, which can dictate how we want to educate the participants going forward. Whether we want to focus on saving for retirement or paying off credit card debt, whether people are thinking about how they're going to care for their elderly parent. Do we need to start talking a little bit more about long-term care and how that could be a benefit for you? So stuff even just outside of the deferred comp plans, just trying to take a more holistic view of things.
And so we did send out our questionnaire, right? And we had the results, right? We saw those.
But that was last year. Are we gonna
Those they,
send one out this year?
Send out another one.
And we should look at some of these questions.
Yeah, I'd be curious to see those answers.
But we better, if we're gonna send out a questionnaire this year, we better put it on a future agenda.
Yeah. And Hillis, you have access to our questionnaire before, right, that we had sent out? I mean, we could do like a save as or something, and get a new one out.
Yeah, I'm sure I do. I just have to, I'll talk to Erica about it.
I think that was on our work plan too.
It's usually in October.
Some work plan as an annual.
It was in the fall, but I don't think it was as late as October.
Okay.
Okay, thank you. Thank you.
Thank you.
Oh, no problem. Sorry I took all the time.
Okay, so I'll jump into the next item. So what we put in the packet is an attempt to, like, at the last meeting, we had brought like a very succinct description of implementing a plan where there would be one fiduciary who would be part of the Deferred Comp Advisory Committee. And the questions that came up were like, well, so then what is everybody's role? Specifically, who does what if we change the structure? And so this is an attempt to detail really who does what. Deborah Walker and I met with Meadow and Eric to really talk through this and make sure that we all understood what we were aiming for. And so here's a draft, I guess, for us to begin to chip away at, continue to chip away at, I guess.
Where is that trend?
That's on agenda
It's
item.
the last
page.
page.
2 pages.
The other thing I'll say that came up in our last meeting was like, the board had directed us to try to have one recommendation from staff and from the deferred comp committee. It's seeming like that is going to be maybe not possible, and so I'm passing out to everybody. I don't think I made enough copies, sorry. Oh, I didn't. So this is the memo that was written last June that was the district's recommendation for what the district would, what staff would recommend for the advisory structure. And so passing this out to you again, just to lay out that this is still the idealized structure. And so it does seem like the deferred comp advisory committee is going in a different direction from where the staff recommendation would be.
I thought we had talked about this and thought this would be a joint recommendation. Did something change after our last meeting?
Yes.
No. Well, okay then.
So, yeah.
So I mean, but do we know what? So this is it. This? I'm
So
confused.
that is.
So still the same thing. No changes.
I can offer something.
Yeah.
Okay.
You guys want me to offer something? So I will admit, as we are talking through who should be the fiduciary for the district, I was, very interested in hearing the idea of having a single fiduciary represent the deferred compensation plans. However, as I meet with district management, that is not a proposal that they're interested in. Having a single fiduciary is maybe not providing the qualifications that would be necessary to, provide human resources, legal and financial support to the plans. And so they are not feeling like a single fiduciary is the right way to move forward. And so I don't think we're going to have a joint recommendation if that is the recommendation of the committee. There really is a strong desire to, follow those best practices that say that knowledge, experience, and, using the job description to bring forward the fiduciary responsibilities is really what management's recommendation is going to continue to be. So the memo doesn't have to be, the memo is just a reminder that it had those 3 options in there. I think there's still ways to kind of tinker with those 3 options, but really, I think the major points of it is the board remains the fiduciary. There's a separate fiduciary body, which is made up of those job descriptions that include financial, human resources, and legal background. Or the committee becomes a fiduciary. I think those are still very strong recommendations from district staff. Just want to go over that.
Okay.
So,
Yeah, it's just weird to have district staff make recommendations, but they don't come to the meeting or go to the training. I don't know, it's just kind of strange to me. I know you guys have a hard stop at 12. So I guess we'll just have to review this and I don't know. Pick it up the next time. Yes, yeah. Yeah, we'll put on the agenda for next time. Or just move this item, I guess.
The next one's May 25th. Are you guys okay with maybe going 2 hours for the
Yeah,
next one?
it used to be 2 hours and then it got reduced, so I
Well,
wasn't
because we
sure.
thought we were having more meetings, so we thought we
Oh.
could reduce them, but.
Yeah.
Is that what you're doing, or-
Yeah, that's fine.
Okay, all right. I just want to check for public comment, we'll make sure we don't lose that. Is there any public comment? Anything? Kelly, you have anything else?
Is this for item 7?
This is for item number. This is, yes, public comment is for item 7. We were just talking about item number 5, and so we're skipping 6, I guess.
Okay. Yeah. Just want to, you're talking about fiduciary stuff, but I want to bring this back to what this park district is supposed to be
Sorry, I
doing.
can't hear you, Kelly. Could you speak? Oh, there you go. That's better.
All right. Can you hear me now?
Yes.
All right. So want to bring this back to the basic job of the park district, which is to provide parks and regional parks for people to visit. And little example for you, straight from Castro Valley. They have this kind of like a city council, even though it's not. And a week or two ago, they heard the members of that council said that they were hearing from the park district that the park district didn't want to open up somebody wants to build 10 houses right next to the park, and they're offering to build a gate and build a little walkway all through the side of their property, down the driveway, whatever, and people would be able to walk into the regional park at Lake Chabot Regional Park. And the Castro Valley politicians said, no, we're hearing from the park district telling us that they're worried about safety and security or something or other. And I really don't understand it. It's mystifying to me. It's also distressing to me. But the park district doesn't want another opening over there, halfway between the regional public safety headquarters and the Redwood Road, near Proctor Road. Well, then another week passed by, and they had another meeting of this Castro Valley political body, and they heard from this woman. And I want to play you a little tape, a little audio from this local resident, a woman who was walking down the street with her 7-year-old daughter, and watched. And you just listen to the tone of voice. Just listen to this local resident there, and to get an idea of why they need to be able to walk into parks and get off the street. Here we go.
Hi, hello, I'm Rosa, and I live on Proctor, and I witnessed the accident that happened the other day with my 7-year-old daughter right in front of me, and it's really disheartening to feel like I feel like you're insinuating that these issues didn't exist before the accident.
All right. So that's 30 seconds worth. So what happened? What kind of accident was it? Well, there was another mother with another 7-year-old, but this is a boy, not a girl, a 7-year-old boy. And the boy survived the crash when a large SUV, there's no sidewalks over there, so the large SUV hit them both. But the large SUV severely damaged the mother, severely damaged. And that's why I would like to ask you as employees of the Park District, and maybe some of you are mothers, and maybe most of you had mothers. I would hope all of you had mothers, and you would think about opening up, when you get a chance and somebody hands it to you on a silver platter and says, here, I want to build you a gate into your park. You think about Proctor Road, which is right in front of this proposed gate. You think about what's happening out on the road and how many mothers are getting smashed by large SUVs and the little children. And go listen to this tape. Go figure out what's happening on that road, and go get your priorities straight. Thank you.
Thank you, Kelly. Great. That's all we have for today. Thank you, everyone. We lost our visual over here, so hopefully we're okay.
Time's out.
No.
All right. Bye, everybody.
Bye. Yeah, public comment and people can comment on any item that's on the agenda. So.
Maybe at the space time.
Thank you, Connie. You can probably end the stream officially.
We can't, we lost the videos.
Shannon, can you end it, please?